All right, so the question is, why did I lose money when I was right on the direction? So this is for options. This is for buying options, and this happened to me recently during an earnings play, and I have a good example and wanted to go over it. So ticker symbol is DE. This is John Deere, Deere & Company. So essentially what I was looking for here was a big downward move on earnings. It was already trading below the 200-day moving average, and it had a couple bounces off of this long-term uptrend. This is also the same week that Target had a 30% down move on earnings because of inflation, increased transportation cost, and margin compression. Their profit margins were shrinking. So I was hoping to see a similar move on Deere. We did get the big gap down. It was down about 8% right away in the morning, about $30 a share it was down. But my put option lost about 40% right away in the morning. So what happened? So this is because of something called IV crush, or implied volatility crush. IV crush is a rapid decrease in implied volatility of an option. So implied volatility is basically the market's expected move, or the market's forecast of likely movement in a security's price. So the market opened up with the implied volatility of this option being about 60%. When the market closed the day before, the IV was about 110%. So you can see it was down about 54% right away when I took this screenshot. And that's basically saying, like, market makers are expecting a big move as an earnings reaction. If the stock price moves less than what is expected because of the implied volatility, the option is going to end up losing value. If the move in the stock price is greater than the expected move, then your option will actually gain value. So let's look at this thing. So this is a 300 strike May 27th put. And you can see I bought it on May 19th. So this was a 1 week option, and I bought it for $1.80. I bought two of them. So here is about when I bought it. It's about $1.80. And this is a put option. So the option should be gaining value if the stock price is going down, right? But here's the stock price. You can see this is about the time that I bought it. Stock price was flat for a little bit, and then the stock price ended up going up. So my put should be losing value typically, but you can see it's actually gaining value because of the implied volatility increasing right before earnings. And then this big move was the next day when it dropped. So implied volatility up here went from about 110% to about 60% when it was down here. So this is just another shot showing $1.80 when I bought it, and at the end of the day it was actually worth $2.60 because of the implied volatility increasing throughout the day. So this screenshot was taken about 15 minutes before the end of the day. You can see this is about $2.60. So it was actually up 45%, even though the stock price ended up increasing a little bit throughout the day because of the implied volatility increasing. So the option value here is increasing because implied volatility is increasing, and implied volatility is increasing because the market is expecting to have a large move because of an earnings reaction. And then you can also see I did short 10 shares. All right, so how can I prevent this? How can I prevent losing money due to IV crush? So option number one, don't trade earnings. So around earnings time, option premiums will tend to increase because the market is expecting a large move or a large reaction due to earnings. So it will price in some of that move. So if your move is less than the expected move, the option will lose money. If your move is greater than the expected move, then you'll make money. Option number two is just don't buy options for earnings. You can easily not play earnings. A lot of people don't play earnings. Or you can sell options for earnings. So if you're selling options, you're on the other side of that trade, and you can actually use the implied volatility in your favor, and the IV crush will actually work for you. Option three is just to buy or sell the stock. You can see in the example before, I also did short 10 shares. So then I'm not affected by implied volatility or anything like that. Option number four is to buy a different option with a different strike price and a different date. So that one was a 1 week option. So that's going to be a lot more sensitive to the implied volatility. And it was also out of the money, so it didn't have any intrinsic value attached to it. So let's compare two different options here. So this one is out of the money, 1 week out, 300 strike put. And this one was in the money, 1 month out. So you can see the difference in the reactions here. This one, implied volatility was really high, about 110%. I'm not sure what the exact IV was on this one, but this is the one I traded, and it dropped significantly. Way out of the money, because this was at like 360 when I bought this. The stock price was at 360 when I bought this. And this one here was already in the money. So this one's going to be less sensitive to the implied volatility, and you also have a higher delta and intrinsic value attached to this one because this one's already in the money. So this one probably did lose a little bit from the implied volatility, but the delta and the other Greeks made up for it. So same move, two different options. One loses about 40%, one gains about 40%. Here I was just showing the short position. I did short the 10 shares, so that ended up working out pretty decent for me. Ended up closing this for about a 16% gain. So minus what I lost on the options, I still ended up making about 11%. And I just put a note down here that this position ratio is not representative of my trading capital. This is just one account, and I have other accounts that I'm working with, so not a good idea to trade options on earnings with 50% of your account. Just a little risk management tip there. And then this was just the final result at the end of the day, so I wanted to add a little bit of insult to injury here and show you this one. The stock price did end up moving a lot lower throughout the rest of the day, down to about 307 from around 330 when it opened. So the stock price did continue to move in a downward direction, so it would have been great if I held it, but that wasn't my original plan. So my initial plan was to watch for a large earnings reaction and then see what the option price did. So I got the big move down on a gap down, and it actually lost value. So I just cut it right away. Hindsight is always 20/20 here, but you can see the rest of the day it ended up running because the stock price continued to fall throughout the day. So I sold it for about 110, and it actually ran to 645 at the top and then closed at 450 for the day. So that's like a 250, 300% gain at the end of the day if I would have held it the whole day. But the big thing for me was following my plan. So my plan was to just trade the reaction to earnings. I did what I was planning on doing. I saw the earnings reaction didn't work the way I wanted it to and cut it. Because if this thing would have went sideways through the rest of the day, or it would have bounced and went back up the rest of the day, this would have been worth even a lot less than what I sold it for. It's always easy to say shoulda, woulda, coulda when you look back at it in hindsight, but the big thing is to just have a plan and follow your plan. So to recap, IV crush, it's a rapid decrease in implied volatility of an option. Typically, options will have an implied volatility range that they like to trade in. If they're far outside of that range, you can benefit from it. But if it's typically trading at a 50% implied volatility and it's at 120% around earnings, when it reverts to the mean or it reverts back to where it typically trades, that's when you see your implied volatility crush and your rapid decrease in implied volatility. So hopefully that makes sense. Thanks for watching. Have a good one.